Hi everyone, good evening and welcome to the third and penultimate installment of our Master Your Finances webinar. It's been crazy. So this is actually the third week. It's actually really hard to believe that we're almost at the end. If you had joined us for the last two sessions, or if you have actually joined us for any of our Master Finances sessions before, welcome back. If this is your first time, welcome. So as I shared last week and the weeks before, this round, our Master Your Finances series runs a little differently compared to what we had done in the past. So we've actually gone beyond the personal finance as well as investing basics, and hopefully up till today have actually gotten everyone on a similar level if you've actually caught us in the last two webinars as well, especially if you've also been able to practice a couple of things that we've also shared during the last two webinars. We went through key steps to building a portfolio. And last week we spoke a little bit about fixed income, where I actually dove a little deeper into bonds. This week we're going to explore the world of ETFs. And next week, we actually have something very special. So I will be speaking to Dinesh, who's actually one of the co-founders of the popular financial sites, Dollar and Cents. So we have some news. Due to actually overwhelming response for the webinar, we've decided to actually make it a physical event. And I do hope that everyone joining us today would be open to joining us. I hope to meet everyone. I'm sending the RSVP link to Eventbrite to the chat right now. I would really appreciate it if you guys could sign up, come down to our office, join us. I would really like to meet everyone. And it will be super exciting. So we do want to bring this virtual into reality. If you can't make it, that's fine. We will still be streaming it on our webinars. We will still be streaming it live via webinar. But obviously, we would definitely love to meet all of you in person. So as I mentioned, initially we wanted to do a webinar. We had really good feedback. We had really great responses. So now we actually want to make it a physical event. So please do sign up. Come down to our office, join us. It's happening next week, 7 to 8 p.m. Registration starts some around 6:30. So feel free to join us. So that's next week. And by the end of basically these four sessions, we definitely do want everyone. Oh, my audio seems to be cutting in and out. Is that the case for everyone? Let me just fix that. All right. Okay, hopefully it's better. Thanks for that feedback. Just let me know if you actually cannot really hear me very well. But yeah, as I mentioned, so next week we will be initially we had planned for it to be a webinar, but now we're making it a virtual event. I've just sent the RSVP link to the group chat. So hopefully everyone, you can sign up, come down to our office. We'd love to meet you. It starts from 7 to 8 p.m. If you can't make it, if you already signed up, you prefer to stay at home, feel free to do that as well, because we're still streaming it as a webinar. So Dinesh and I will be talking about his entrepreneurial journey, and we'll also be talking about his own personal finance journey. So it'll be quite an exciting conversation. I'll be there, Dinesh will be there, StashAway team will be there. We'd love to meet you once again. But at the end of it, and by the end of the session next week as well, we do hope that everyone is well prepared and well on their way toward building sustainable wealth for the long term, as well as make sound financial decisions. Now, thank you for joining me tonight. Once again, I'm May. I'm currently the head of client experience at StashAway. It's nice to meet everyone here. So if you are here today, you are basically here to learn a little bit more about ETFs. And if you're someone who has not started investing, I hope that after tonight's session, you'll be more confident to take the first step. So before we move on to the main event, this is just a short introduction of StashAway. So for those who may not know who we are a digital wealth management platform. We were founded in Singapore, and since then we actually have expanded into 4 other countries across the region. So that includes Malaysia, Thailand, Hong Kong, as well as Dubai. We are licensed in all 5 jurisdictions, including Singapore. We are backed by some of the biggest investors in the world. This includes Sequoia, Fidelity, as well as Hamilton Lane. And along the years, we've also collected multiple accolades, with the most recent being named one of the high-growth companies in APAC by Financial Times, as well as one of the top 200 global fintech companies by CNBC. So We've also launched multiple portfolios across our platforms for our users. So what you see here on your screen is a high-level overview. Again, after today, I do hope that you will take the first step to deposit your first $100, $1,000, $5,000 into one of these portfolios, hopefully. Of course, if you feel like you need more guidance to help understand our products or figuring out which portfolio is actually more suited for whatever goals that you may have, please feel free to reach out to our team, support@stashaway.com. We're also available on WhatsApp. You can also drop us a call, but if email is your preferred form of communication, we are available at support@stashaway.com. And also, just a little bit of housekeeping before I get to the main meat of today's event. We are live on both Zoom as well as YouTube. So if you have any questions at all about this session, any questions about StashAway, any questions about maybe your personal portfolio, please feel free to use the Zoom Q&A button if you're watching us on Zoom. If you don't see it actually on your screen, it might be hidden behind the More button. So if you click, there'll be a little bit of a drop down. You'll be able to see the Q&A button. If you're watching us on YouTube, just feel free to use the YouTube chat. My colleagues are basically available on both platforms. They will help me answer some questions where possible. And I'll also answer, some questions at the end of the session. Moving on. So this is actually just a general overview of how our app looks. So as you see, made this UX super easy for everyone. But again, if you need help, we are available at support@stashaway.com. Now, what you see here are basically the 4 parts to today's session. And as you can see, we are going to try to cover all the bases when it comes to ETFs, starting with an introduction to ETFs. Then we'll talk a little bit about structures as well as the types of ETFs. Then we'll move on to how you can actually build an ETF portfolio. And then we'll talk a little bit about how you can actually implement an ETF investment strategy. So first things first, let's go very deep, hopefully deep enough into the introduction to ETFs. Like all my other sessions, I try to make it as interactive as possible. I do want to also understand our audience. I do also want to understand how we can, continue to help you. So, there will be some points where I would, in the session where I would, require, or I would, like for you guys to also interact with me if, for certain questions. We also have a couple of Slido links. So if you can also get your phone ready, if you're watching on your computer, there will be some questions where, it'll be great to just kind of get a sense of what your understanding is and how we can also potentially help you going forward. Then moving on to that. So the first thing you see here is a QR code that should lead you to a Slido. So if I could trouble you to scan this, we actually have 2 questions for everyone to just sort of, answer today. So if everyone can just whip out your phone to scan the Slido. If you can't, we will share the Slido link in the chat. Everyone, please feel free to click on that Slido link if you can't. Let me just switch my screen to the Slido. All right, so we already have people answering. If I could trouble everyone actually, to just sort of take this little poll so we can also understand where everyone is when it comes to ETFs or stocks. Okay, so we do see a large majority of people in stocks. Okay, if you can't actually access the link, we've sent the link. If you still can't access it, what you see on your screen, there's a QR code. Or you can go to slido.com and key in the number 4171597. All right, so we still do see people voting. Oh, very interesting. More people in stocks, it seems. We have some in neither. Ah, you're right. Both is not an option. Apologies for that. Should have put both. Okay, let's go with this. If both are not sure, which one has a heavier weightage in your portfolio? If it's stocks, click stocks. If it's ETF, click ETF. If it's neither, click neither. Okay, well, okay, so most people are, let's call it heavier into stocks, individual stocks. So I'm glad that you're actually in this webinar tonight. Hopefully we can convince you to kind of skew the other way, but all is fine. Wow. Okay, I think it's quite clear stocks are winning the race by a mile. Okay, so let's move on to the next question. I think you guys should be able to, it's basically free text. You should be able to key that in. I just want to know what's one thing you're curious about regarding ETFs, or is there something specific that you'd like to learn about ETFs tonight? Everything. Okay, good answer. Very good answer. Okay, how does it work? Dollar works, buy, cost, ETF, everything. What's the cheapest way to invest? Okay, how it works. Gotcha. Okay, we have some people who's written in the chat, what's the main difference between ETF and unit trust? Okay, let's go on. I will cover that. I'll cover a little bit of that later on, so do stay tuned. Want to prio ETFs much more in the future? Prioritize, I'm assuming. Okay, how to invest in ETFs? We have that as well. What is ETFs? With risk of ETFs? All right, let me just give it a few more seconds. We do see people typing. Selection criteria. Risk of ETF compared to stocks. Okay, that's a good one. Yeah, okay, this is great. I mean, I hope I'm able to answer most of this. And I hope, we'll actually be able to kind of help people who, especially people, the individuals who have typed in this word bubble. Hopefully, we'll also be able to help you um, understand and give you a rough guidance and answer to potentially what you want to learn about ETFs tonight. So yeah, thank you so much for participating. This is actually really, really good answers. And it's also good to know that say for example, for us at StashAway, if there's any sort of specific content that we should actually just kind of push out in the future, I think this is extremely helpful for us. So, thank you very much for participating. So in the interest of time, let me just go back to our presentation and then we can dive a lot deeper into basically the first thing tonight. So, crux of it, what is ETF? So ETF, very simply, is a basket of securities like stocks, bonds, anything that you can trade basically. And basically you trade an ETF like a single stock on a stock exchange, and it also offers you diversification as well as flexibility. Now, one of the more famous and I guess most talked about ETFs in the world, and you probably have heard of it, even if you've never invested before, is probably the S&P 500. So basically buying one share of the S&P 500 ETF on a public stock, on a stock exchange, basically allows you access to 500 of the largest companies in the US. So you basically, when you buy a share of an ETF, you're essentially buying a tiny piece of all these companies, and the value of the ETF shares kind of goes up and down based on how well these 500 companies in the context of the S&P 500 are performing overall. Now, this is actually a good way to explain where ETF sits in between mutual funds as well as stocks. So an ETF is basically part of both worlds with its own set of benefits. So just now, we had one of our friends, one of our users, one of our viewers actually wanting to understand the difference between ETFs and mutual stocks and unit trust, sorry. So mutual funds are, in a sense, a bit like basically unit trust to a certain extent. So an ETF, like stocks, it's listed in the public markets. It's traded during market open times, and you can buy and sell based on the prices that you see. So you can either buy a market if you decide to, I don't know, queue at a lower price, you can do that. And hopefully, much like stocks, if it drops to that low price, you basically buy the ETF at that price. If you choose to sell because it's also liquid, you want to sell at a higher price than what is actually presented in the market today, you can also do that. You can basically queue, much like a normal stock, and hopefully hits that price and you basically exit that ETF. So it functions a little bit like a stock that way. ETFs, like mutual funds, basically it is a basket of securities and is also professionally managed by specific fund managers. So different fund managers may issue certain ETFs themselves. So what actually sets an ETF apart from these two then are its diversification as well as cost. So let me kind of dive a little bit deeper into that, right? So compared to stocks, ETFs, yes, they are also publicly traded. They're obviously more diversified, right? So instead of buying, say, for example, the S&P 500, using that again as an example, you buy one S&P 500 share, you get exposure to 500 of the largest companies in the US. You can choose to do that. You can choose to basically go to your standard brokerage and buy 500 shares yourself. Or you can just buy the S&P 500. So this, and essentially just buying one share of S&P 500 versus you sitting down and very, very hardworkingly, you sit down and you kind of scroll through 500 of the companies in S&P 500, you buy them individually. Obviously, cost-wise, it works out a lot cheaper for you to just buy one S&P 500 ETF. And the ETF, unlike mutual funds or unit trusts in this case, they have a cheaper expense ratio. Now, expense ratio is basically the annual fee that is being charged by the fund manager. And ETFs are also generally more passively managed. So the fees you pay are actually lower as well compared to mutual funds. The one thing I would say is also for mutual funds, unit trusts, a lot of times there is a minimum investable amount that you actually need to commit. Whereas for ETFs, I mean, nowadays you can also buy fractional shares, quote unquote. So like, for example, on StashAway, we have our flex portfolios. If let's say you only have $1,000, you can buy, I think right now the S&P 500, if I'm not mistaken, is about $5,000. So with $1,000, you can take a position into the S&P 500. So right now in today's day and age, you are also allowed to buy fractional, which is a little bit different from, I guess, mutual funds or unit trusts, because for mutual funds, sometimes there is a minimum requirement to commit a certain sum. So that's kind of the key difference between the three. And then there are also all these similarities. And then obviously then you have ETFs. So here are some core reasons why ETFs are essentially also a great way for you to. So first of all, as I mentioned, they're lower in costs. Generally, they are lower in expense ratios. So the annual fee that you pay to the fund manager is, a lot lower than mutual funds as well as unit trusts. They're also more accessible. So compared to mutual funds, unit trusts, they trade publicly. Tomorrow morning or tonight, essentially at about 9:30 when the US market opens, you decide to buy an ETF on the US market, you're able to do that. You don't have to, wait for a fund manager. You don't have to go see someone sign some paper. So it's a lot more accessible in nature. It's way more transparent. So unlike mutual funds, you can easily see the holdings on a daily basis. Because it's also traded publicly, you can actually see the price movement on a daily basis, how much it closed, how much it opened, what was the highest for the day. So it's transparent in that way. The fourth thing is obviously, unlike individual stocks, it allows you and it gives you that diversification. So you buy one ETF, you instantly get exposure to a basket of securities. And obviously that reduces basically a single stock risk. The fifth thing is, I guess, is flexible. I mean, that kind of ties hand in hand with accessible. So it's basically mainly due because, it's accessible in the public market. You can buy when you want. Tomorrow morning, you decide, you know what, I want to kind of exit a specific ETF and enter a different ETF. You can do that. So it's a lot more flexible in nature that way. And as I mentioned earlier on, one of the big things is that there's no minimum required investor and commitment that you need to do. There's also different ways for you to get access to it in a fractional manner. As I mentioned, if you only have $1,000 or $2,000, you can actually, as an example, StashAway's Flex portfolio, you can choose the S&P 500 ETF, put in $2,000, and then you basically buy a piece of it. So you don't have to also commit the full sum. So it's getting a lot more convenient to invest in ETFs. And what you see here on screen are basically some of the key reasons why it's extremely beneficial for us to start looking or at least invest in ETFs. Okay. Moving on to the next portion, we'll talk a little bit more about structures and types. So once again, if you have any questions, Zoom Q&A function. If you're on YouTube, please feel free to use the YouTube chat button. Okay, so the first thing, we're going back to basics a little bit to understand a little bit more about ETFs, right? So ETFs do transact in both the primary as well as secondary market. But in the primary market, this is actually predominantly done by issuers and authorized participants of specific ETFs. So why they do this is to ensure that the price of the ETF that we see as buyers and sellers and consumers remains close to the value of the underlying assets. So now that sounds a little bit complex. I won't dive too deep into that. What they do is basically, say for example, if there is any sort of excess in what they do is they actually redeem. Let me just try to break it down a little bit more. They redeem as well as create ETFs to ensure that there is enough liquidity in the market. So as I mentioned, this is very technical. It's a good to know for all of us, but know that the secondary market is actually where you and I transact ETFs. So this part is basically more important for us. We do buy and sell ETFs in the secondary market itself. And obviously in the secondary market, because it's publicly traded, it definitely provides liquidity as well as easy access for individuals like you and I to buy and sell as and when we do decide we want to take positions or exit positions in specific ETFs. Now, many strategies do exist mandates. So market index is where a specific ETF tracks the broader market indexes. And then there's obviously sector as well as country-specific ETFs. And then there's the smart beta strategy. So smart beta strategies use various factors and rules to enhance returns, to reduce risk, or to improve the diversification compared to the other two standard strategies that we see. Now, a few things to note, right? The underlying strategy will essentially determine the ETF's performance as well as risk profile. So as an example, among the three strategies that you see here on screen, so the market index strategy, whether it's a sector or country specific strategy, and a smart beta strategy, a country and sector specific strategy is actually the most high risk because the exposure is fairly narrow in nature. But given that it's high risk, there is also potential for higher return. Market index is typically the lowest because it's usually very diversified, extremely diversified, and the mandate is really purely to reflect the performance of the overall market. So there may be years or potentially days when it slightly outperforms, but generally it is quite stable. So basically where I also do keep in mind that the underlying strategy does also determine the performance as well as risk profile of the specific ETF. The second thing is the strategy also defines how the asset manager determines the holdings as well as the methodology. And I think the two core things that you should also know as an ETF investor is that you need to be aware of their strategy for it to be aligned with your goals, as a different strategy would suit different market conditions and investor preference. So as an example, if you're someone who's extremely conservative, taking like a very country specific or sector specific risk might be a little bit too high risk for you. So what you can do is you can actually just look into the ETF a little bit more. You can actually Google it, and then you will be presented with a fact sheet. Click on that fact sheet, have a look and see what the underlying assets are. If you're comfortable with basically investing in these underlying assets, then by all means take a position. But if you feel like you're not comfortable, then please do not actually put yourself in that position. So it really also is incredibly important that you actually do also look at the underlying assets to just really have a sense as to whether or not this is something that aligns with your personal sort of investing preference and your own personal investing methodology. Now, looking at ETF prices, there are two kind of ways and usually two terms that we kind of look at. So the first thing is intraday pricing. So that is basically the day-to-day market pricing, right? So basically whatever you see in the market when it opens, whatever you see in the market today when it closes, that's the intraday pricing. You do have the NAV or net asset value, which is basically the total value of the ETF holdings divided by the number of shares outstanding. So as investors, we generally look more on the daily price. NAV is usually a little bit more applicable if you're invested in like unit trusts and stuff like that. But otherwise, as investors, I think the daily price is something that would be of more importance to us. Now, what you see here on screen are basically the different types of ETFs. So again, when you invest in ETFs, it kind of goes through a whole range that you also sort of need to, eventually these are things that would come naturally, but there are different types. So obviously the first thing is the style. So the style can either be, do you want it to track a market? Do you want it to be growth, which is, generally a little bit more high risk? Do you only want the exposure to be to blue chips, so that's large cap? And then you can also have an ETF that just tracks market indexes, right? That's one. As I mentioned just now, you can have one that actually just gives you a specific sector or geography exposure. And you can also have some ETFs that are, I know I mentioned that, ETFs are predominantly a little bit more passively managed, but there are also options for more actively managed ones versus passively managed ones. And then we have some examples of ETFs here. So these are actually what we also have on StashAway platform. So we have the S&P 500, we have a bond ETF, and then we also have an ETF that allows you and gives you exposure to gold. There are obviously so much more, but what I want to do is to kind of just give you an idea of the variety of exposure that you can get with ETFs. And also with each ETF, as you can see, the number of securities are basically also a little bit different. So for example, for gold, it's an ETF that kind of tracks gold prices. So the underlying asset is basically spot gold. And essentially by getting exposure to this, you don't need to go out and buy physical gold as one thing. These are things that you can explore within the ETF universe. And ETF has basically come a long way since it first started in the I believe it was in the early 1900s, maybe, or 1950s. I could be wrong, don't quote me on that. But ETF has come a long way, and you can get different exposure across different sectors, different geographies, commodities, just by using ETFs. So it's definitely worth exploring, especially for those who have just now in the earlier poll mentioned that you are either a little bit heavier on stocks or you potentially don't even have exposure to ETFs or stocks. ETFs is definitely a good way for you to get that exposure to very, very broad-ranging market exposure, sector exposure, geography exposure, or commodities. Okay, so moving on to the next part, let's talk a little bit more about how we can basically build an ETF portfolio. So, I've hoped that I've been able to give you some insights, or at least some high-level insights into ETFs, how they work, some of their benefits. If the stocks camp earlier on, hopefully you will consider diversifying yourself a little bit more into ETFs. And if you were the neither camp, I hope that you will actually start using ETFs to gain exposure to the markets. But let's say right now you're here, you want to get started. So how do you build an ETF portfolio? Now, this is something that we actually can't stress enough, and that's diversify. Diversify, diversify, diversify. We've mentioned this many times, and we will actually keep going to ensure that basically we're all aware of its benefits. And diversification, very simply, it just means spreading your investments across different types of assets to reduce your risk. Now, let's kind of run through a very high, I guess, core investment concept about why you shouldn't put all your eggs into one basket. Now, first of all, when you diversify, you are spreading your risks across different assets, different sectors, and then that essentially means you're reducing the overall risk of your investment portfolios. By actually reducing the overall risk, you are protecting yourself against significant market movements as well as volatility, because obviously your portfolio is extremely balanced. And because of the balance of that portfolio, and you're sort of minimizing the volatility and movement of your portfolio on a daily basis, you actually have the potential for more stable as well as steady returns, because you will definitely be seeing less swings on your portfolios. And the last but not least, the broader exposure definitely allows you to capture any sort of opportunity, or at least more opportunities across the market, versus if you were to just kind of limit yourself to exposure to a very, very specific stock or sector. So that's why it's so important for you to diversify, right? Now, we should also take on an asset allocation approach. Now, I spoke about this strategy, or an asset allocation sort of strategy, in the first series. So if that's something that you did not join us for, that's all good. Please do scroll our StashAway YouTube and just kind of look for the first Master Your Finances series. We did dive a little bit deeper into the whole asset allocation strategy. But just to give everyone and get everyone up to speed, an asset allocation strategy is basically the process of dividing your money into different assets to achieve your financial goals while taking into account your risk tolerance. Now, we also do talk a lot about risks, and I can't stress enough how managing your risks is extremely important when it comes to building a portfolio. Now, what you see on your screen here are three main, I guess, risk profiles across the spectrum. So we have the conservative to the moderate to the aggressive. Now, here are some key characteristics to each of this sort of risk profile, right? For the conservative, generally, you may be more into capital preservation as well as stability, and you want to minimize your risk as much as possible. So you generally would take more positions into, I guess, income generating assets or assets that are a little more low in risk. If you're someone who's a little bit more moderate or is comfortable taking moderate risks, that means you probably prefer a little more balanced approach to what you're investing ethos, and you're okay to take some risk, but you're still fairly conservative. And you probably have a fair or like balanced exposure to both growth as well as yield stocks or yield assets, right? If you're someone who's a little bit more aggressive in investment style, not in personality, you're probably more focused on growth. So you're open to taking higher risks for higher return, right? So you have also potentially a longer time horizon, and that then allows you to be a little bit more aggressive in your investment sort of strategy, right? So everyone's circumstance is different, and it really depends on your capacity and your ability and risk tolerance to take risk. And it's really not limited to age. I know a lot of people think that, oh, if someone's younger can potentially be a little bit more willing to take more aggressive kind of take into someone who's a little bit older might potentially be a little bit more conservative. But the reality is there's no one size fits all. It's really one size fits one. And I do say this a lot because I really believe this. For example, two people in their mid-20s who seem to have similar circumstance, probably have just graduated, have a little bit of money. They have maybe very different risk profiles. Just one might have slightly more knowledge when it comes to investing. One might not have as much experience. Or one perhaps has just not been exposed enough to the world of investing, or is just starting and is just learning. And two individuals who are potentially approaching retirement, you would think that they are both probably a little bit more conservative, but one person might actually be taking a more aggressive approach when it comes to investing, just because of circumstance, because they might potentially have more knowledge, or they potentially have a higher income. So it's actually really, really different. So the age is not really a limiting factor, or it should not be a limiting factor, and it's not the only factor. When it comes to really understanding your own risk profile, it really differs by individual from individual. But I think where I'm trying to get at is that when you're actually building a portfolio, or when you're actually investing in anything in general, it's extremely important that you understand your own risk tolerance. And we do say this a lot here at StashAway, is that if you actually invest in a specific asset, or if you find yourself investing in something and you feel like you can't actually sleep at night because the movement or the volatility is actually keeping you up, then it might be something that it's actually too high on the risk scale for you. So you might actually want to rethink your investment strategy or your risk or your exposure to that particular asset that you have actually invested in. So this is why risk management is something that's extremely important. And I think a lot of people do not pay attention enough to this, because a lot of times when we go out and invest, we like to just look at how much can I make from this, right? And that's also what is usually being pushed to us and what's being sold to us. So I think if anything, if there's anything that you walk away with tonight, I hope it's the fact that you understand the importance of risk management and you actually take active steps to understand your own risk tolerance to help you make better and more sustainable investing decisions going forward. All right, now moving on, investing with ETFs. So Warren Buffett actually said this: the trick is not to pick the right company. The trick is to buy all the key companies through the S&P 500 and to do it consistently. So as I mentioned, buying into an ETF allows you the capacity to buy into a larger pool and be consistent with it, right? So ETFs are also great in case you don't know how to invest. So as an example, right now everyone's excited about AI. Everyone's excited about blockchain. If you're looking at certain geographies, people are excited about India, people are excited about Japan. And then you might be sitting at home one day thinking to yourself, oh, I actually want to invest in all this, but where do I start? How do I start? And spoiler alert, you can actually get exposure to all this via ETFs because there are already fund managers who are looking at the best companies and pulling them into a specific ETF and listing all this on exchanges for you to get exposure to. So ETFs are also a great way for you to get exposure into certain geographies, into certain sectors that you might actually want to bet on for the next couple of years. So that's actually the beauty of ETF. And that's actually an ETFs, as I mentioned before, is actually a great way for you to get started in the investing world. Now, this next slide here of an asset allocation strategy that is extremely diversified and low cost. So it's actually a real portfolio from StashAway itself. And generally, you can see that we've also diversified across the assets, and within the assets itself, it's also extremely diversified. So within US equities, we diversify into the S&P 500, healthcare, energy. Within global equities, we diversify into specific equities in India and Japan. So all these sort of balancing factors help to sort of kind of level out the movement of the portfolio a little bit more. And this is how you actually create a portfolio for yourself. And this is actually an example of a portfolio that can give you very, very steady returns. I'm not saying that, there won't be down days. I'm not saying that there won't be any volatility. There will still be volatility. But when you zoom out in the long run, it should actually trend upwards in an extremely steady manner. And obviously, these kind of portfolios would give you less emotional stress, especially on down days in the markets. So what do you need to do? What's the one thing that you need to do? I know I talk a lot, but what's the one thing that you need to do when it comes to then building a portfolio? So the first thing is obviously determine your risk profile. So again, as an example here, I've used StashAway as an example. What you see here across the 4 points are basically the StashAway risk index for our general investing portfolios. Now, let me just give you an explanation of what the risk index means. So StashAway risk index. So for example, you see 6.5%, that's actually our lowest risk portfolio. So an SRI or StashAway risk index 6.5% portfolio means that in a 1-year period, there will only be a 99% chance that you would be losing more than 6.5% of your portfolio. So let me repeat that. An SRI 6.5% portfolio, what it essentially means is that in a 1-year period, there's only a 1% chance that you might lose more than 6.5%. So for every $1,000 that you invest, there's only a 1% chance that you actually are down more than $65, right? So that means that it's not completely risk-free, but what we're trying to do here is actually minimize risk as much as possible. So on the flip side, if you're someone who likes to take risks, you're extremely high risk, and you choose the 36% SRI portfolio, which you see here, that's actually a high investing portfolio. What this essentially means is then in a 1-year period, there's only a 1% chance you might lose 36% of your investment. And this is actually unrealized because it's only realized if you decide to sell the asset. Obviously, if you are willing to sit through the volatility, and if you're a long-term investor, any short-term volatility should not technically scare you. So an SRI 36% means that in a given year, there's only a 1% chance you might lose more. Every $1,000 that you invest, you might lose more than $360. So you also have to try to make sure that you're comfortable with that possibility. And you're comfortable with potentially seeing that when you open the app one day, because markets are generally down, and sit through that volatility. Because as I mentioned, in the long run, when you zoom out, markets always trend up. So first things first is to determine your risk, your own risk tolerance, your own risk profile. And then the second thing is obviously to diversify to maximize your returns. So the bottom, what you see are the returns in 2023 for our portfolios in USD terms. So I think what this really shows you is that even though I mentioned a diversified portfolio gives you steady and stable returns, the returns are definitely not boring. I mean, even in our lowest risk portfolios, the returns for about 11% for a very diversified portfolio and a portfolio that's slightly heavier in fixed income because of the low risk nature of the portfolio. And obviously a portfolio that's higher in risk, which has higher exposure to equities. The growth aspect of it is obviously a little bit higher, hence the returns are a lot higher, but generally a diversified portfolio does also give you pretty good returns. Now, let's dive deeper into diversification a little bit. Now, as I mentioned, diversification, sorry, it's quite a little bit of a tongue twister when you say it many times. So diversification not only means giving you exposure to many types of assets, there are also different ways for you to get diversification. We hear a lot about sectors, sectors meaning, for example, tech sector, the healthcare sector, but what else can you actually diversify into? Well, first, there's geographical. So this means different countries, different economies, different opportunities across economies as well as sectors. Some countries are higher in risk than others for various reasons, political, geopolitical, maybe they're just generally, they're considered emerging markets. So you can also diversify across this. So as an example, when you invest in emerging markets, you definitely have potential for higher returns, say if you were to invest in a fully developed market. But yes, you are taking on higher risks. And you'll also be able to diversify across the different strengths of the various countries' currencies. So this is why geographical diversification is important as well. And we can also diversify across assets. So last week I dived a little deeper into bonds. So, why would you actually consider diversifying into fixed income assets? Because you might tell me, hey, May, I like growth. I like to see my portfolio up 20% a year. Bonds are too boring. But the reality is when you diversify using assets like fixed income, bonds are, yes, they don't move as much as equities. But that's also because they are lower in risk compared to equity. So generally with a bond or a fixed income in your portfolio, it helps to kind of smoothen out the returns. So this definitely helps to protect your downside risk, and it provides some sort of buffer against any sort of losses that you may have. So for example, if you have a portfolio that is, you have exposure in equities and you also have exposure in bonds. Let's say, for example, tonight the market open, there's some adverse news that comes out, the equity market kind of drops. Because there are bonds there kind of holding your portfolio, the drop in your total portfolio would not be as, let's call it the swing would not be as wild as if you were to just have like 100% exposure into equities. And also fixed income exposure can also give you regular payouts. And it can also provide you with regular cash flow. So there are some individuals who prefer fixed income assets because of this aspect. Bonds also do not move in tandem with equities. So generally, the more common thing that we see in the market is that if equities were to come down, bonds would actually go up. If bonds were to come down, equities would actually are actually going up. So this generally basically this generally helps to improve your overall risk in your portfolio. Now, I talk a lot about benefits, but there are some potential mistakes that we can make when it comes to ETF investing that can just basically also outweigh the benefits a lot, right? So the first things first, you may try to attempt to time the market, which then may potentially lead to you kind of over trading. I think this is just a habit that a lot of people also generally have. And this can basically cancel out potentially all the gains that you may have made. If you try to basically buy and sell ETFs with a broker, this leads to increased costs. And you can also potentially just be racking up losses because you're just constantly buying and selling. And you may just be investing in an ETF, but you actually don't understand what the underlying is or what the assets in the ETF actually is. And assets in the ETF may actually be higher in risk than you actually thought. And you're probably only looking at the past returns, which is not an indication of the future returns. So your portfolio may be actually be over-concentrated in just one ETF, right? Which then skews the total risk of your portfolio as well. There's also a currency risk that you may not be able to manage well yourself. So these are things that you definitely should be looking out for before you actually take the first step into investing in ETFs. Or generally, talk to a professional, talk to someone who can help you, ask questions, try to understand as much as possible about ETFs, understand the structure, have a look at the potentially underlying assets. As I mentioned, investing is not one size fits all. It's really one size fits one. So make sure you're understanding it for yourself and make sure you're comfortable with the investment that you're taking for yourself. The last thing for this section is that if there is anything I want you to take away from this section that we just actually spoke about, it's that successful investing in general, or ETF investing, requires patience, it requires discipline, and it requires you actually having a long-term perspective. So take your time, understand your own personal risk tolerance, learn about what you don't know, because there is actually a lot that we don't know. Ask questions and leverage on the resources that you have around you, whether it's technology, whether it's books, whether it's friends or family who are in the financial sector or who have some knowledge about investing. Leverage on all these resources, have conversations, and learn more about what you don't know, just so that you can actually make sound financial and investing decisions. Okay, lastly, let's talk a little bit more about implementing your ETF investment strategy. Just now, or literally just 20 seconds ago, I talked about leveraging resources around you, right? So there are obviously two ways that you can invest in ETFs today. You can go the route of doing it yourself through traditional brokerage firms, or you can leverage on digital wealth platforms like StashAway. There's a ton of us out there. As an example, given your time, your resource, and the fact that we should actually optimize our life for low cost conveniences, in my opinion, digital platforms are the way to go. Now, we exist to help you build and protect your wealth in a simple, cost-effective, as well as intelligent way. How we do this? Well, obviously, the first things first, low barrier to entry. There's no minimum. It's extremely low in cost compared to potentially a traditional brokerage. And we make investing accessible to everyone, regardless of your capital capacity. You only have $100, you only have $200. I think there is a misconception that you need a lot of money to start investing and you need a lot of money to make a lot of money. Spoiler alert, that's not true. I think the big thing that we all need to do is really just start, regardless of the capital that we have. If we're able to set aside X amount every month, every week, every 2 weeks, invest that sum. Second thing is obviously automated. I talk a lot about asset allocation. Sure, you can go on the website or you can go on like specific mutual funds, you can replicate the portfolios yourself. But what will happen when there is a requirement to rebalance or shift specific assets due to the change in economy when it's needed, right? The third thing is obviously cost. Now, fees for digital platforms are generally much lower than traditional players. And the fourth thing is diversification. One of the most important thing, obviously, as I mentioned, and we can't stress it enough, is the need for you to take a broad exposure across markets to basically help you capitalize on opportunities everywhere in the world, really. And obviously, the last thing is risk management, right? So this kind of ties into automated investing. This is all done for you on platforms. So why would you not, trade your time? Why would you actually just trade your time for something like that's convenient and low cost, right? Now, you take the convenient option. So what's next? So there are actually three important things when it comes to investing: habit, discipline, as well as your mindset. So let's start with the habit. So setting up a habit to consistently deposit, or what we call dollar cost average, into this portfolio. What this essentially means that you basically regularly invest the same amount of money, either bi-weekly, monthly, or weekly, if you can, into a specific portfolio. Now, this is definitely great to help you take the stress out of investing. And remember, it's not about timing the market. We should never be timing the market because no one really knows what happens in the market. It's really all about time in the market. Now, here's an example of the effectiveness of dollar cost averaging. So on the chart, it showcases you two ways to invest a capital of about $6,000, right? So person A, one way is going all in today on one asset, which is the yellow dotted line that you see. The other is then splitting the sum up across different timelines, and that's basically the green up and down line that you see, right? So two people, person A decides to kind of go all in today, 6,000. They buy at $2 per share. So that means it gives them an exposure of 3,000 shares. 6,000 divided by 2, you get 3,000 shares, right? Person B takes the approach where they split their 6,000 that they have across the board and basically buy at different times. Through the ups and downs, they deploy a certain amount every time. If it's higher now, I buy. If it's lower, I don't know if it'll go lower, but it's a good opportunity, so I buy more. So at the end of it, person B does end up with more exposure. They end up with 4,005 shares compared to just 3,000 shares. And they also have a much lower average cost, just because whenever markets are down, they decide to buy a little bit more. Whenever markets are up, they also decide to buy a little bit more. And this actually is extremely helpful if you have a strong conviction for a specific asset. And this is also why it's extremely important for you to dollar cost average. It's not just a case of just spending the whole lump sum that you have today. It's more so the case of if you're able to set aside a certain amount every month, or in a specific timeline that's comfortable to you. Some people like to do it weekly. Some people like to do it once every 2 weeks. Some people like to do it monthly. It's entirely up to you. So regardless of whether markets are up, market are down, you just buy a little bit more because first of all, you're investing for the long term. And secondly, you have high conviction for this specific asset that you're invested in. I think at the end of it, after across a few years, you will definitely see that you would have not just accumulated a good amount of exposure to a specific asset, but you would also potentially have accumulated it at a much, much better average cost compared to potentially someone who has just put a lump sum into that. So the second thing is discipline, as I mentioned. Now, staying disciplined actually in investing is one of the hardest things to do, but it's actually very, very important. Now, one thing to do is consistently rebalance your portfolio, right? So what does rebalancing actually mean? So as an example, you buy two assets, you have $1,000, you decide you're gonna put 500 and 500, so it's gonna be 50-50. And then over the course of a couple of months, couple of years, one asset has gone up, significantly in price, and one asset unfortunately has dipped. So this has kind of skewed your portfolio to, let's say, an exposure of 70% versus 30%, just because of the price increase that has actually created a larger value in your portfolio. So the right thing to do then is to basically sell some of the asset that has gone up, take some profit, and then use that cash to buy more into the asset that has dropped down, or whose price has dropped down, for you to kind of bring the level back up to a 50-50 level. Now, let me kind of put that example into your visuals, right? So you have two examples here. You have two asset exposure. Initially, when you started, you decided to take, sorry, I apologize for the little typo there. It's basically the blue is meant to be 60 at the beginning. So you decide to take a 60% exposure to stocks and a 40% exposure to bonds. Stocks have gone up. So now the weightage of your whole portfolio is a 75% exposure to stocks, but a 25% exposure to bonds. But remember, stocks are also higher in risk. So now your portfolio risk is obviously skewed a little bit higher. So you rebalance it. You sell some stocks. You use that cash to buy more into bonds to kind of bring it back to a more 60-40. Otherwise, you're basically opening your portfolio to more risk, right? Is it important to rebalance? So obviously, by rebalancing, it kind of keeps it aligned to your initial ethos of your risk comfort level and investment goals. Second thing is that you have potential for better returns, because what you're essentially doing is you're buying low as well as you're selling high. And this also allows you to basically periodically assess your own investment strategy. Now, last but not least, one of the more important things is obviously your mindset. So habits, discipline, mindset. Always take a long-term view when it comes to investing. So with longer-term views, you're avoiding yourself succumbing to any sort of short-term market fluctuations. And this also minimizes stress, because if every day you see that, oh no, my portfolio is down, I must sell. Oh no, it's up, FOMO, I'll buy. And tomorrow it's down. There's just so much stress involved in this. So by actually taking a long-term view, as I mentioned, you, regardless of whether markets are up or markets are down, you still DCA in, because you know that you're investing for the long haul. This is actually one of the best things you can kind of do for yourself. and it also reduces stress significantly, right? Now, reason I am saying this is that although on a daily basis, there is a lot of volatility, when you zoom out in the long run and you take a long-term view, markets always trend upwards. So as you see here on the graph, and also right now, every other week, the S&P 500 seems to be touching a new high. But then there will always be volatility, but at the end of the day, it seems to just still constantly be trending upwards. So I'm not saying that you're not going to be experiencing volatility if you enter into the markets today or if you start buying ETFs today. But if you have the view that, look, I'm not going to be touching this, I have the discipline to not touch this for the next 10, 20 years because this is what I'm going to be retiring on. And this is a solid ETF, and I believe in this ETF. Then the daily fluctuations, the weekly fluctuations actually should not bother you that much. Now, what you can also see here is a little bit of a moving graph. Now, markets are also extremely noisy. On a daily basis, we're constantly reading very, very different headlines that can basically create like panic across, people investing and across the financial sector, right? Now, what you see here is if you had, say, for example, invested $10,000 into the S&P 500 for 20 years, this is a simulation that we did. If across 20 years, regardless of all the noise, you stayed invested, over the course of 20 years, the 10,000 that you invested will essentially grow to about $64,800. If you had just missed 10 days, 10 of the best days across the 20-year period, you would see that the returns have significantly gone down by half, or more than half. If you just miss 40 days across 20 years, your returns would basically have dwindled to just $8,000. So it would actually be a lot less than when you started. And what I mean by miss is, let's say for today, markets go down, you decide to exit and take whatever profit you may have, and then markets seem to be recovering, and then you try to get in again. This actually really, really impacts your returns. So I think the key to it is to really stay invested, dollar cost average, to allow there to be a compound growth on your returns. Now, the next thing, before I go to the next thing, these are some of the benefits of long-term investing. First of all, compound growth. So as I mentioned, when markets are down, you don't just exit and you don't panic. You keep putting money in regardless of high or lows. Your money actually compounds. Second thing is definitely it helps you meet your long-term goals. By staying invested, it helps you sort of ride out any sort of volatility and helps prevent any sort of emotional investing. And with emotional investing or without emotional investing, at least there's less of an impulse to buy and sell and panic buy and sell. So that actually kind of helps keep you invested in the market, because remember, it's not timing the market, it's timing the market. Now, the next thing I actually want to talk about, which is actually rarely spoken about, is SRS. So SRS is Supplementary Retirement Scheme. If you're a Singapore resident, regardless of your status, so meaning regardless of whether you're a citizen, regardless of whether you're a permanent resident, or even if you're neither, but you are a Singapore resident, you are eligible to contribute to SRS, or your Supplementary Retirement Scheme. And unlike CPF, which is compulsory for citizens as well as PRs, SRS is purely voluntary. But the main difference for both citizens and PRs, as well as, let's call it, expats, is the contribution amount. So if you're a Singaporean citizen or PR, on a yearly basis, your yearly contribution is capped at 15,300. If you're an expat or a foreigner, but you're a Singapore resident, your yearly contribution is capped at 35,700. When I talk about year, this is actually calendar year, so 1st January to 31st December. Now, why do I actually want to talk about SRS? One of the main advantage of SRS is the tax relief that you actually get from contributing to SRS. So contributions to SRS are actually tax deductible. So as an example, if let's say you are an expat in Singapore, you are able to contribute to a maximum of 35,700 a year. Let's say your yearly income is 150K. You would basically be taxed on 150 minus 35,700. So that's about 114,300-ish roughly, right? So that means your taxable income is only about 114,000 a year. The thing about SRS is that you are actually locked up for a specific time period. So if you're a citizen or PR, the funds that you contribute to your SRS are actually locked up until the statutory retirement date. The reason I put here 62 or 63 is because they actually changed that, I believe in 2022. So if you have started your account before 1st July 2022, you will be locked out until 62. If you have started after 1st July 2022, you'll be locked out until 63. And this is for Singaporeans or PRs. If you are an expat or a foreigner, but a Singapore resident, if on the 10th year of your SRS account being started, if you are still not a Singaporean or a PR, you can actually withdraw the money. Withdrawals at either the statutory retirement date for Singaporeans and PRs or the 10th year of either residency in Singapore or 10th year of your SRS account if you're not a Singaporean or resident, Singaporean or PR in Singapore. Withdrawals after the quote unquote lockup period are only subject to 50% tax, meaning, after the, let's call it lockup period, if I decide to withdraw, let's say 50,000, I'm only going to be taxed on $25,000. Now, there's actually more nuances to this tax. We don't have the time, actually, because we're at 8 p.m. already. We don't actually have the time to run very deep into the details, but we are doing a webinar on SRS in November. So if you're interested, please do look out for the invite in your inbox. If you have any further questions, please feel free to reach out to us at support@stashaway.com. If you actually want to see how much SRS or how much your contribution to SRS can actually affect your taxable income, what you can do is you can actually go to our website and there's actually this simulator. Actually, what I can do very quickly is, this is our actual website. Let me just send a link here to the chat. So you can actually go to this website. We have this calculator here, as you can see, where you can kind of play around with the numbers to sort of see how much tax you actually would have to pay if you were to contribute to SRS. So as an example, if you're Singaporean or PR, you have personal reliefs up to $45,000 and you contribute every year 15,300. So with SRS, you can see your taxable income is at 89,700 minus all your tax deductibles. Without SRS, just minus whatever tax relief that you have, it's 105,000. So you do see the difference in tax that you would pay is about 1,760. So you save about 29%. Obviously, you can kind of play around with this number. Maybe you're a higher earner as an example, right? So obviously, the higher you earn, the more it kind of makes sense. If you are a foreigner, as an example, unfortunately for foreigners here in Singapore, you're not eligible for the personal relief, like citizens as well as PRs. So that's why your max contribution for SRS is also higher. You can see the difference in terms of contribution is your total tax savings is about like 41%. So that's actually quite significant. And whatever you save on a yearly basis, you can also invest these funds. So it's actually, something that I believe is not talked about a lot, especially SRS. So that's why I kind of want to bring it up today. Because one of the reasons is also with SRS right now at StashAway, you can actually invest in ETFs as well. So, but I'll talk about that a little bit later. Feel free to kind of use the calculator, play around a little bit just to understand your own circumstance. Again, there's a lot of nuances, obviously, but I won't run into that today because, I won't dive deep into that today just because of time constraints. But as I mentioned, we will be doing a webinar in November. Stay tuned and watch out for that in your inbox. Otherwise, please feel free to reach out to us at support@stashaway.com. Now, moving on. Now, one of the reasons I also want to talk about it is because a lot of people actually potentially are aware of SRS and they have started an SRS account. Now, SRS accounts, you can only you can sign up for an SRS account at the 3 local banks here in Singapore. So either UOB, OCBC, or DBS, depending on who your preferred banking partner is. And you're only allowed one SRS account. So, please feel free to pick whichever is your preferred banking partner, log onto their digital iBank or app and, start their SRS account. It's fairly easy. But the thing is, a lot of people deposit cash into the SRS account without actually knowing that your SRS bank account only gives you 0.05% per annum. You heard me right? An SRS account only gives you 0.05% per annum. That's actually very little. I'm not sure what you can do with that for your retirement. And these things are basically this cash is locked up for your retirement. So the one thing I do want to encourage everyone here, if you already have an SRS account, is to actually start investing your SRS funds. Now, SRS can actually be invested into stocks, ETFs, bonds, or fixed deposits. For the purpose of today, obviously, I'm going to be talking a little bit more about ETFs. What does an SRS investment timeline looks like? So obviously you already know you're locked up for a specific time period. If you're non-citizen or PR, you're locked up for a 10-year period. If you're citizen or PR, you're locked up for an average of 20, 30 years until the statutory retirement date. So even at 50, there's still a good time period, especially if you're working, for you to actually benefit from the tax relief, right? Here at StashAway, all our portfolios, save for our alternative portfolios, which is only specifically for accredited investors, you can actually invest your SRS funds in them. For ETFs, obviously, they are probably only in our core portfolios or thematic portfolios. One thing to note, and why I'm also here to kind of share, is that I think traditionally, SRS has, in Singapore, the main exposure that people generally have just been getting is our Singapore assets. But right now, we actually allow you to actually invest in US assets. So as an example, let's say your SRS funds are locked up, quote unquote, for the next 10, 15 years. Why not invest in the S&P 500, right? On average, the S&P 500 has given, I think in the last 50, 60 years, on average has given, through all the highs and lows, 9% returns. It's way better than 0.05%. So, definitely this is one thing I kind of want to drive home, is that invest your SRS funds if you already have SRS funds in your SRS account with either UOB, DBS, or OCBC. Now, I know I've run over time. We're at the end. So some key takeaways from today. First of all, diversify your ETF strategy. This is something that is extremely important. Have an asset allocation strategy. Second thing is determine your risk comfort level. Very, very, very important. Whether you're conservative, you're moderate, or you're an aggressive investor. Third thing, it's not about timing the market, it's time in the market. So make sure you are aware of the ETF you're investing in, its underlying assets. As I mentioned, it could be a lot more high risk than you actually think it is. And the fourth thing, last but not least, the core investing principles I talked about, dollar cost average, build a habit, rebalance your portfolios, be disciplined about it, and maintain a long-term investing mindset. Have a good mindset and have the mindset that whatever you're investing for is for the long term, so that you don't succumb to the daily investment stress of the market volatility. Now, as always, thank you for listening to me. This is a free investing code for those who actually want to kind of try out StashAway. If you're already using StashAway, please feel free to scan this code. It should actually apply directly to the app. Otherwise, feel free to use code MYF 2024. We will actually be managing up to 100,000, including your SRS funds, up to 100,000 of your next deposits for free for 3 months. So we are actually helping you save on fees in that regard. Thank you so much for listening to me. Now, I know we've run slightly over time, but let me spend like 5 to 10 minutes answering some questions, because I do see we have some questions coming. All right, first question. What is the percentage chance of gaining 5%? Oof, I wish I can tell you this. The reality is we can't predict the market, so I can't tell you what the chance is of getting 5%. But really, rather than focusing on the returns, I want you to sort of think more about your own personal risk tolerance. So if you're investing in something that tells you there is a 5% chance of there is a chance of you gaining 5%, try to understand the risk that's involved. Because if, let's say, it's something that's extremely high risk and it's something that you're not comfortable with, don't take that chance, because I think the stress of you actually thinking about it every day is not worth the cognitive load. So I wish I could answer this question, but I can't really answer this question because nobody knows what's going to happen in the market. But what I do want to encourage you to think about more than what is my potential return is what is the risk that what is the risk I'm taking in this investment that I'm going to be exposing myself to. Yeah, so that's probably the answer for the first question. Second question, which of the flexible portfolio and StashAway would you recommend if one were to select from a template? Oh, that's a really good question. I think our templates are very, very different though. So if I'm not mistaken, we have 4 core templates. So I mean, okay, what I can do is I can kind of run through what these templates are just to kind of explain it to you. So if you just give me a moment so that I don't get this wrong, I'm actually opening my app myself. Portfolio. All right, template. Okay, so yes, so I'm right. So we have 4. So we have USD cash yield, passive income, risk focus, and world index tracking. So USD cash yield is basically if you have excess US dollars, this is a way for you to get yield on US dollars. You can also invest and deposit Sing dollars, and it will convert to US dollars for you. But the main goal of USD cash yield is for you to basically get yield on US dollars. The underlying of the USD cash yield portfolio are actually US treasuries. So it's super, super safe. And it's a great alternative for any sort of US dollar bank account that you may have, right? Passive income is more for individuals who might potentially want yield or dividend. But if that's actually the direction you go, I think the one portfolio that you can also explore is our JP Morgan income investing portfolio, because that's also basically a yield portfolio for you. Risk focus is more global diversified, so it's much broader in nature. It gives you a much broader exposure. There is a potential for it to be kind of high risk as well. So it really depends on what your risk capacity is, because even when you click within it, there are different categories. World index tracking is a little bit more stable, and then you're able to see the split of the kind of stock composition, as well as bond composition a little bit more. And that generally would probably give you more steady returns. So it really depends on what your general mandate is. So the best I can do for you right now, without really understanding your circumstance, is kind of run through what each of the portfolio really is. And hopefully that kind of helps you make a decision. Okay, June asks, how frequently should we do rebalancing? Okay, so if you're invested with StashAway, we actually rebalance quite frequently. Rebalancing, so in StashAway, we have 2 concepts, rebalancing and reoptimization. Rebalancing is what I mentioned earlier on. We noticed that the skew of your portfolio is kind of skewed a little bit too high already. You had selected to choose you had selected a certain risk index. Right now, because of market movements, it's skewed way past that. So we rebalance it to kind of bring it back down. That actually happens quite frequently. For reoptimization, which is a term that we also use, is when we completely remove assets and replace assets. So that's when there's a bigger market movement that happens less frequently. That probably happens, I don't know, I can't even tell you because it really depends on market data. But for us, on average, I think we only reoptimize and remove specific assets and put new assets in. Maybe so far it's been once every 1.5, 2 years. So reoptimization is slightly longer. But if rebalancing at StashAway because it's obviously automated, number one. Number two, there's an algorithm running, making sure that all the portfolios for our users are within the risk parameter they have selected. So it happens quite frequently. But obviously, as yourself, as an individual investor, you probably don't have the time and capacity to sit down every day to kind of look at it. So maybe making it like maybe a bi-weekly or monthly practice might be a good thing for yourself. But obviously, if you have a lot of assets, it's a lot of work. That's why I brought in the conversation of leveraging on the resources that you have around you. If there's an automated or wealth management platform that you like, it might be worthwhile actually leveraging on the technology that they may have. But for you as an individual investor, maybe bi-weekly, monthly, because markets move quite a bit. And obviously, whenever you hit certain milestones in life, it might also be good for you to relook at your investment strategy, relook at your own portfolio, and then decide for yourself if you actually need to rebalance to sort of match the strategy that you currently are in, because the strategy that you have today and 1 year ago could be completely different. So that's probably how frequently you should maybe look at it. All right, 8:15. Let's just do a few more questions. What do you think? What do you think? Will the market react positively or negatively if Trump wins the US election? I know that Donald Trump is favorable towards blockchain or crypto as he is Elon Musk. Okay. So we will actually be doing a webinar on this. I'm not in a position to answer this. So we will actually be doing a webinar on this. So we're doing a returns webinar tomorrow, actually, with our CIO, and she might actually be able to give a little bit more insights into this. But yes, Donald Trump is a little bit more liberal toward crypto, not because he has Elon Musk. I think generally he is a lot more liberal to that, as well as the VP that's running beside him, JD Vance, is also quite pro crypto. I mean, if you're alluding to it, whether or not the crypto market might go up, I can't answer that, unfortunately. In terms of whether the market react positively, I think regardless of who wins, they both have very different policies that could be beneficial for the market in different ways. But as any election that has happened in the past, whenever there's a result, there is usually a knee-jerk reaction. So markets are usually volatile for a while. And then the two camps or either camps would then release their policies. And then that's when we might see a little bit more stability in the market. But generally, unfortunately, I'm not in a position to answer this. But as I mentioned, we actually do have a returns webinar coming up tomorrow. I would encourage you to watch it. CIO will be probably more in a better position to answer this than I am. So I'm sorry, I can't actually answer this at this point in time. Christina, does StashAway agree with Goldman Sachs' view? Does StashAway agree with Goldman Sachs' view that S&P 500 will have a total return of only 3% the next decade? This is actually an interesting view from Goldman Sachs. Again, I can't answer this, unfortunately. On behalf of StashAway, I can't do that. But generally, I think this is a very important view. I actually have not heard this. So I would actually need to research more before I can give you a direct answer to this. So Christina, unfortunately, sorry, I can't actually answer this question. Okay, Christina again. So is long-term investing still relevant to a retiree? Yeah, of course. I mean, the reality is like, okay, long-term investing is applicable anywhere in life, especially given that today, the average lifespan is getting longer, especially with how advanced medical technology is. So ultimately, long-term investing is applicable in every specific stage of life. What changes in the different stages of life is potentially your risk tolerance. So if you're someone who was younger, you have a steady income, you know that, look, I'm in my mid-30s, I have another 30 years of investing. I have the capacity to take to take more risk because I know I have frequent paychecks for potentially the next 30 years. And then when you say approach 50, you're like, okay, I plan to retire in the next 5 years. I would have less income coming in. So I should actually take less risk, but actually invest a little bit more into fixed income investing, which is lower in risk. So my capacity to take risk is a lot lower. So I think long-term investing is relevant regardless of where you are in your life. What actually changes is your risk tolerance. So that's something you kind of need to kind of take into account yourself. And also when you're a retiree, assuming you're like 50, 60, I think on average now, the national statistics in Singapore is that the average lifespan, it differs between male and female, but the average lifespan is anywhere from like 80 to 90 now. So I know it's quite a broad range. So let's say you're retired at the statutory retirement of 62 years old, right? You still have at least 18, on average, 18, 19 years ahead of you. So, in my opinion, that's still long-term investing. But I think within that long-term investing, what is actually different is potentially the risk that you take. So Christina, I hope that actually answers your question. All right, last question, and then we'll end the night. It's 8:20. Rodrigo is asking, is there any tax benefit of investing ETFs versus mutual funds versus stocks directly? Okay, so I think there are many layers to this question. So first of all, in Singapore itself, regardless of what you invest in, there's no capital gain tax. So I think that's unless I'm not sure of where you're from. If you're Singaporean, that's great. If you're not from Singapore, I'm not sure if basically your home country actually has specific capital gain tax. So that's potentially something you want to think of. I think generally there are some withholding tax, and the way specific ETFs and mutual funds and stocks do it is quite different. But on a broader sense, in Singapore itself, there's no capital gain tax. So there are no tax benefits between, I think, the three of this. I think for ETFs, it depends on the type of ETF and the fund manager. You could potentially be subjected to some withholding tax, but then that's also returned to you after that. So it really depends on how you have to do your personal tax filing. But broader sense, unfortunately, I can't go into too deep without understanding your own circumstance. But on a broader sense, in Singapore itself, there is generally not much of a difference between ETF stocks as well as unit trusts. I think the unit for mutual funds, it also depends on the kind of assets that they have that might be subjected to certain tax. So it's really on a case-by-case basis. But as I mentioned, in a broader sense, there's no capital gain tax in Singapore. So there really isn't much of a difference in investing in this tree. Yeah. Yep, that would be my answer. Hopefully it's helpful. Okay, last one. SRS can invest in which category? Okay, so SRS can actually be invested. Let me kind of go back a little bit more. Okay, so SRS can be invested in stocks, ETFs, government bonds, or fixed deposits. So you can actually invest your SRS funds in a wide range of categories of asset classes. If you're talking specifically about StashAway, you can actually invest in the cash portfolios, the core portfolios, as well as thematics. For alternatives, unfortunately, you can't invest SRS funds, and the alternatives are also for accredited investors at this point in time. So specific StashAway in cash, where we have money market funds, we have bond funds, core portfolios, where we have bond funds, we have ETFs, and then thematics, which is predominantly ETFs. Singapore investing, we have some funds in there as well. Yes. Okay, Basu, SRI portfolios are part of core. Yes, SRI portfolios, sorry, are under general investing powered by StashAway. Okay, it's 8:22. I actually do not want to keep everyone. I hope this has been a good session. Once again, if you would like to join us next week, as I mentioned, we are bringing it from virtual to a physical session. So please do RSVP here. We would love to meet you at our office here in Singapore. If I couldn't get to your question, I really apologize. Please feel free to reach out to us at support@stashaway.com. Yeah, and with that, once again, thank you so much for your time. The last 2 weeks has been amazing. I've had a lot of fun sharing as much as I can. I hope, you were also able to learn and take that first step toward investing. Obviously, I hope to meet some of you next week. But in the meantime, if you have any questions at all, we are available at support@stashaway.com. Drop us a WhatsApp, drop us an email, drop us a call. And we'll be more than happy to try to help you as much as we can. Until then, hopefully I'll see you next week. Until the next Master Your Finances session, stay safe and keep investing, and all the best. Hopefully see you soon. Take care. Good night. Thank you so much for staying with me until so late. Thank you.